Rogers Communications is out with its third quarter results. Profits slipped, but revenue beat expectations, helped by a one-time gain related to its deal with MLSE and its best wireless customer loyalty in more than 2 years. Let's get more now from Garnet Anderson, head of portfolio management at Tacita Capital. Garnet, thanks very much for joining us today.
Thank you for having me.
Your initial thoughts on those results. What do you like? What are you worried about?
Fairly muted. Going into the industry, you kind of know, so wireless business is bigger than cable business, cable internet business, bigger than media business. And so when you take a look at that, you say, okay, well, for us, it's in the value sleeve of our mandate. And we look at that, A, because valuations are relatively inexpensive. Why? Because expectations are relatively muted. It is a tough wireless environment. You spoke to, $66,000 of those are postpaid subscribers, but they had about 110,000 new subscribers all told. So that's not a bad quarter. That basically equaled the first half. So check mark there. But the actual growth in EBITDA and the growth in revenue are relatively muted. Then you go over to the cable business. That's that's not easy pickings either in today's day and age. And again, and the internet goes into there as well. So they did have new subscribers, 30,000 odd new subscribers to the internet services, which is good. But it's a well-saturated market in Canada. And particularly when you go on the wireless side over to Quebec, it's kind of hyper-competitive if you want over there. So everybody's attention right now is on the media side. And that gets a little cloudy because they increased their ownership of MLSE going back. So the kind of quarter-over-quarter comparisons are a little bit of a challenge there. But certainly, as they point to in their press release, helped by the Blue Jays and the run. And so that certainly has helped. I mean, you kind of go higher attendance is picked over the course of the year. Certainly, the extra playoff games won't hurt. Everybody can do a little mental math there in terms of, okay, if there's 8 games because we're going to win in the 7th of the World Series, tickets, if they sold tickets, not the scalpers and not the resellers, but they sold tickets for average of 500, or 400, and with concessions and what have you, you can easily kind of get up to an extra $100 million of revenue, if you will. Now, only the accountants behind Rogers Wall will really actually know those levers that are pulled, but folks have to realize that there's revenue, and then there's cost of that, there's margins. But it certainly is a nice little bump. And when you take a look at Q4 earnings vis-a-vis Q4 earnings again the prior year, you're seeing a bump up there. When you take a look at analysts, we say some of the sizzle around the media division popped up over the last month. We see where the average target price moved up $1. We see where revenue moved up a couple percent. Profit moved up, marginally, and there was quite a bit of a range around the profitability aspect. So certainly analysts were paying attention, saying, well, there's more cash that's going to come in. And it does set the stage for next year. And we're already starting to trade on 2026. Yeah. And so you kind of go, okay, well, fans won't like to hear this. What will ticket prices go up by? And if you kind of figure, well, they did not sell out every game, can they kind of close that gap? And maybe an extra 3,000 people a year? Do they get some more sponsorships? So it certainly sets the stage for a nice little run up for next year.
But and what should people be watching more? Is it the concern about the number of subscribers? Because we're talking immigration freezes or reductions. Where do you grow? How do you grow it?
I think it is. It's a part yield play. Let's just call it 4%, not quite, but 4% yield. The growth is going to be tough for them to achieve in the Canadian marketplace. And that excludes, and for now, let's ascribe a low probability to it, that as we get into the USMCA negotiations and how does the US play that out? We know that they've floated trial balloons. They want dairy. They want more banking, tier 1 banking, or Schedule A banking access. They want telcos. They want for their companies to come up here. So how much future competition? I don't think that's knowable sitting here in October. So we can put that to the side. But there's a little bit of a risk there. So all told, where do they grow? Cost containing, like bringing in their CapEx. They worked that deal with Blackstone in terms of offloading some of their infrastructure, if you will, in a partnership, or a corporation partnership. So I think it's just one penny at a time, one subscriber at a time, one household at a time. And again, they now own more of MLSE, and they realized a pickup in their value there. Continue to grow that, and sports franchises are growing in value.
Okay, I'm going to wrap it there because we're out of time. We want to get to a couple others quickly. IBM, another one. It looked good.
Looked good.
Not so happy now.
Not so happy now. Off about 8% pre-market. For all intent, revenue checks the box. Efficiencies, they're seeing about $4.5 billion run rate. Backlog looking good. Earnings looking good compared to where they were a year ago. They had like a $2.7 billion pension adjustment. All looking good. The one segment that disappointed the market was really in their cloud software. They're Red Hat, and they're up against some tough competition. That's their high margin area. Their growth rate came off of what it was prior quarter, and that threw the market into a little bit of a tizzy today. So you take a look at that. If it were to sell off more, you would start to think, okay, time to rebalance into, they've got enough of the moving pieces. One of the sizzly parts off to the side is quantum computing, where they're a leader there. Not a pure play, but a leader there, but it's a small component of their business. But it's
for now
salacious little part out there. And, but, there's trading and there's investing. If they were to disappoint in Q4 again, markets really don't like 2 successive quarters of disappointment. So, you may want a dollar cost averaging of its new position, because there could be more upset if they don't catch tread in Q4.
Okay, and we're going to sneak in. We've got about 30 seconds. Storage Vault. One of those ones I think people, what do you need?
Storage Vault, look to the left, look to the right.
There
you got a storage container shop somewhere around you. They basically, they own or manage about 265 units across about 3,000 Canada. It's very much a mom and pop industry. It's a roll-up strategy. Came out of COVID and was on fire, sailed off down to the middle of this year, and then it started to catch tread as the same store sales NOI and start to perk back up as it started to rationalize its operations and get a little bit more profitable. Now, still in a kind of net profit loss level, but starting to head in the direction those losses are narrowing. And so it's up marginally this morning, and that's probably apropos. Had they had negative or disappointing same-store dynamics there, I think we would have seen a sell-off. But again, it just gave a chance to anchor in on this quarter.
Okay. Garnet, thank you very much for joining us today. We appreciate
Thank you.
That was Garnet Anderson, Head of Portfolio Management at Tacita Capital.